Okay, today we're diving straight into a pre-market analysis for DataVault AI, ticker DVLT. The report is urgent, it's all about a potential oversold bounce, and it really hinges on one critical support level, 90 cents. So the whole analysis really builds this case for 90 cents being the line in the sand. It's a very bullish roadmap pointing out that the stock bounced right off that level yesterday. So that's your low-risk entry. It's very focused.
Yeah, that focus is definitely its strength, and 90 cents is a technically sound level to watch. But I do wonder if we've fully prepared for when that plan goes wrong. I mean, that's what separates a good idea from a professional strategy, right? The analysis needs to strengthen its probabilistic rigor by fully mapping the downside implications if the primary support fails.
So the weakness is in the entry idea itself.
No, not at all. The weakness is that the report perfectly defines the buy zone, the targets, but then it gets analytically incomplete on the risk side. We're all in on the reward, but we sort of gloss over what to do if the thesis breaks.
Right.
So 90 cents is the floor, but the analysis doesn't lay out what happens next if DVLT actually breaks through it. And that, it leaves a huge gap in the risk profile. It leaves you unprepared for that fear element it talks about.
Okay, so is the issue here just about, adding a stop loss, or is it something more fundamental about the strategy itself? Because when a level like 90 cents is so central, defining what happens below it almost feels like admitting defeat before you even start.
It's precisely about proving the strategy is conditional. That's the key. A high-level analysis has to define the conditions where the thesis works. It can't just demand you believe in it no matter what the price does. By leaving the downside so vague, you're basically relying on hope if 90 cents cracks, not a predefined tactical response. The suggestion is actually pretty simple. Just integrate a detailed scenario for what to do if the 90 cent support fails. That one change transforms this from, a purely bullish map into a comprehensive, conditional strategy. It shows you've mastered the whole risk landscape, not just the fun part.
That makes sense. It shifts the whole feel of the analysis. So if 90 cents is the pivot, what are the concrete steps? How do you define that safety net without, muddying the bullish message?
You have to use technical references, even if they seem a bit far off right now. So for a concrete example, you need to define the immediate stop-loss trigger. Let's say define a technical stop at 88 cents. You state clearly that below 88, the entire oversold bounce idea is off the table. It's invalidated.
So that's the hard exit?
That's the hard exit. But you also need to detail the action required if volume spikes red when 90 cents gets retested. That tells you sellers aren't done yet. And then you map out the retreat. If 88 fails, where's the next logical test? Maybe it's a prior low, say 75 cents. Just including that level and explaining the shift from bullish entry to defensive retreat, it makes the whole thing so much more robust. It actually makes the urgent title more meaningful because you're prepared for multiple urgent outcomes.
That's a huge structural upgrade. Okay, let's move on. Let's look at the fundamentals. The report includes some important points here. The stock's in the AI sector, which is hot. It's got some after-hour strength, and the big one, the consensus analyst price target is $3.
Right, and those are great points, but I see them all sitting at the very end of the report, almost like an appendix. Structurally, the analysis would benefit from integrating fundamental catalysts directly into the discussion of key resistance levels to justify the high-conviction targets.
So the weakness is their placement?
It's their isolation. Yeah, right now they're just bullet points. They're not actively supporting the technical game plan. The analysis isn't really leveraging that $3 potential to validate the urgency, and more importantly, the magnitude of the bounce it's predicting up toward 120 or 150.
I see. So the fundamentals are just kind of decorating the thesis at the end, not driving it.
Exactly. The two need to be interlocked. So the suggestion is to weave those key fundamental points, especially that massive discount to fair value, right into the analysis of the breakout levels. Use them to explain why the momentum could be so explosive. You're tying the short-term trade to the long-term value.
So the goal isn't just to mention the $3 target as some nice, far-off potential. It's about using that value as the actual engine for the short-term break at $1.20. That makes a lot of sense. You're connecting the value story to the technical trade.
You got it. You're using the fundamental conviction to quantify the short-term potential. If big money starts recognizing that value again, that technical breakout becomes a floodgate. For a concrete example, when you're defining the 120 resistance level, don't just call it yesterday's high. You should explicitly reference the massive discount relative to that $3 target.
Okay.
You could rephrase it to explain that a confirmed break over 120 validates the whole contrarian idea. It signals the reversal is being driven by a recognition that the stock is trading at, like 32% of its perceived value. And that's what justifies the potential to run well past 150. Use the $3 target as the foundational reason why this breakout matters right now.
Marrying that upside potential with the technical trigger, that really reinforces the urgency and the kinetic energy. It's a much more sophisticated framing. Okay, final point. Let's talk about delivery. The tone. The report is deliberately urgent, very bullish, and it has these really specific instructions. I'm thinking of that line, if it touches 92 cents and volume spikes green, load the boat. You can't deny the energy there.
And that energy is a huge strength. You want to keep that intensity. But we have to make sure the analysis still sounds authoritative and objective, even while it's being exciting. So refining the tone and language to anchor the analysis in conditional probability rather than absolute conviction will enhance the material's analytical credibility.
Okay.
The weakness, as I see it, is that phrases like load the boat or calling the rally violent, they inject a lot of emotion. And while that's motivating, it does slightly undermine the objective feel of the technicals. I mean, robust analysis relies on defined triggers and probabilities, not just rhetorical demands. You risk losing some of that hard-earned credibility.
I hear you on the need for rigor. But for this specific kind of trade, that high-energy language is part of the hook, isn't it? Aren't we at risk of losing the excitement if we swap load the boat for some, dry definition of a volume profile? The reader is there for the aggression.
That's a fair challenge. The goal is definitely not to be dry. It's to be precisely aggressive. You can command attention with precision just as well as with emotion. So the suggestion is to keep the urgent flavor, but just reframe the action triggers. Use more precise, analytical language. You're aligning the aggressive stance with high confidence based on data you can actually see. We're moving from just urgent conviction to actually defining confirmation.
So it's still aggressive, but the trigger is technical, defensible.
Exactly. And we can do that with some concrete examples. Instead of load the boat, you define the volume profile for that high conviction entry. Maybe you say something like, look for volume exceeding 200% of the 5-day average at the 92-cent retest. Scale in aggressively only upon confirmed volume action. See? You're still using the word aggressively, but it's anchored to a data trigger.
Right.
And similarly, instead of a violet snapback, which is subjective, maybe call it a high-magnitude reversal predicated on short covering pressure. That language is still strong, but it's grounded in actual market mechanics. It just elevates the professionalism without losing the excitement.
That calibration is definitely key. It makes the analysis sound professionally committed, not just bullish.